Fiscal and Monetary Policies by Moon Bial. So fiscal policies is broken up between supply-side economics or demand-side economics. Supply-side economics believes in tax cuts on businesses and investors. They believe in trickle-down economics, which is the process that starts with helping the wealthier groups, which eventually boosts spending in the market, and it goes down to the lower class and gives them more jobs. They believe in deregulation, and it helps to allow companies to start faster or work more, or more work could be done without regulations against them. And this is usually on the Republican side view, and that the tax cut will eventually get overridden by the spending and high market profit. For demand-side economics, it's based off of the Keynesian economics. They look to the government to make policies and uses social programs to give back to the people. They tax higher on the wealthy and corporations to pay for the programs. They believe in the deficit is not bad. They use automatic stabilizers like unemployment insurance or entitlements like Social Security. With a multiplier and an accelerator occur, investment changes and the GDP goes down. It's why the government steps in. Federal Reserve, it is where monetary policies are made, regulation for checks and money accounted for, and it helps with inflation rates and supervised commercial banks. There are 6 key parts: the Board of Governors, the Federal Advisory Council, Federal Open Market, and there you have 12 district banks and reserve banks. So the Federal Open Market, they promote steady growth in the economy, create regulations to help inflation rates, decide monetary policies, and affect the cost of credit. Board of Governors helps with policies for interest rates. There's 7 members. They write regulations for banks, and they study trends in the economy. The Federal Advisory Council, there's several members, and they maintain money supply. They supervise banks, consumer legislation, and the federal government bank. They deal with currency, and they are the members of the 12 district banks. And the reserve banks provide financial services and payment, and they supervise commercial banks like Bank of America. So what is monetary policy? It is the regulation availability to make the money supply easier or harder to obtain or increase for individuals, businesses, and banks in the economy. So there's a difference between tight versus loose money. So loose money decreases the interest rate, it reduces reserve requirements, and it expands open market operations. The purpose is so people can buy more for less, which increases inflation in the economy. Tight money increases interest rates, raise reserve requirements, and expand open market operations. The purpose is to make it harder to loan money, to reduce inflation, to slow the economy at a better rate. The use of monetary policy. First, it can higher or lower discount rate. Higher rates, less money the bank can get, so it slows down loans or federal money supply. Opposite, for lower, they can give more, so greater money supply. There's also buying of government bond, and this increases the money supply. You gain money while it sits and matures. It allows for quantitative easing, more money to spend later on. And then there's also a required ratio, and this makes banks keep money on hand for depositors. It protects us from mishaps like the Great Depression, and it can make the reserve requirements low, which keeps less money in the bank, so more money supplies increase and people can go spend it in the economy. So how can we use monetary and fiscal policy? So fiscal policy, we should continue with tax cuts on investors and businesses so that they can stay afloat during COVID, and it can make new, better companies. This allows for consumers to still spend at the businesses, keeping the economy running. If we hit a recession, then businesses can still stay in business and we can still spend money there. For monetary policy, since we hit a low in the economy when COVID hit, a start to a recession, it would be best that there is a low reserve requirement so that loans can be purchased for houses, cars, etc. And this puts more money to people's pockets, so greater money supply to better the economy. Thank you.